So we're going to talk about life insurance. Most of you might be protected by life insurance from one of your parents, both your parents. Um, but if you were to graduate, move out of your parents' house right now, you probably don't need life insurance. But as soon as you have a family, as soon as maybe somebody is depending on you, especially your kids, that's when you really need to be thinking about life insurance. Okay? So here we go. Yep, sorry about that. So there's your learning objectives. So why do people buy life insurance? You see here, it's 37% protect their loved ones, 30% say it's for their final expenses, make sure they can pay their funeral off. Sometimes it's to leave an inheritance. 27% says to pay off the mortgage. And the key thing here is 1 in 3 families might not be able to make it financially if one of them is gone. So what is life insurance? It's we purchase a policy, okay, by paying the premium, that's like the bill for it, so that when the policyholder dies, then the money goes to a beneficiary, the person that benefits, beneficiary. In an endowment, the amount is paid to the policyholder while living. Okay. So that's a different time. We'll talk about that later. So purpose of life insurance is to protect someone who depends on you for finances. Okay, so that's why I say typically if you have kids, that's when you would be buying life insurance, or it could be just a spouse that is maybe not working. So here are other reasons that people purchase life insurance, which is what I just talked about a minute ago. Okay, so this provide lump sum payments to children when they reach a specific age. Endowment. So that simply means that sometimes, especially if you're very wealthy, you can leave an inheritance to your children, but if they're not like of 18 years old yet, you don't really want them to be able to have whatever, a bunch of money to be able to spend because you don't think they're that responsible. So it goes into what we call an endowment, so that once certain stipulations are met, maybe they have to graduate college, that then they can have that money. Or it's to simply cover funeral costs. You can also use life insurance to accumulate savings, and we'll talk about that, about the different types of life insurance. So let's go back to the funeral. I'm not going to quiz you on this, just kind of trivia here. This is kind of like from the low to high range when it comes to funerals. So we pretty much have 2 options in the United States. You can either be cremated or buried with a full service funeral. The average cost of funerals is about $9,000. That's everything, basically. For whatever reason, Washington, D.C. is very expensive, $13,000, $7,000 for just a cremation. We're down to like $500 for cremation down in Washington. And there you can see kind of some of the differences between being buried, okay, and then having cremation. You can see it's really not a whole lot different. Now, I'm sure that's going to vary depending on what part of the country you're in. But anyway, just for your information. So when we talk about life insurance, the insurance companies have actuarials, which some of you I know are thinking about being actuarials, which are kind of really just fancy word for math people, if you will. They're going to figure out kind of how long it's expected for you to live, and they often use what's called mortality tables. And after COVID, the mortality tables got changed because so many people died, and actually life expectancy in the United States dropped like a year. Show the number of deaths, and I'll show you what a mortality table looks like in a second. And life expectancy, as I just mentioned, just went down because of COVID, but prior to that, it was increasing. So here we have, let's say someone like yourself, which is probably 20 years old, the mortality table would say you would live 57 more years. So on average, males would live to about 77, females would live to about 81.8, about 82 years. That's where you are now. So how do we determine our needs for life insurance? Do you even need life insurance? Well, I've already kind of told you kind of what are the factors. Do you have people that are financially reliant on you. Um, so you have small children are typically the greatest need for insurance. Okay? So also can be determined by how much money you want to leave, like as an inheritance. Um, when would you like to be able to retire? These are just kind of questions you can be thinking about. You know, can you afford life insurance and so on? So here are some more specific methods. We've got a few of them in your book. The multiple of income method. Once again, it's hard to have one model fits all, but these are just kind of rough rules of thumb. So for example, these two numbers are going to be twice as much. So you just say, okay, what's your annual income, and take a number between 5 and 10 of that, and that's what your life insurance is. That's what we call multiple of income method. The easy method, typical family needs 70% of your salary for 7 years. You know, so if you're making 100 grand, 70% of that is 70,000, and you multiply that by 7 years, a lot of sevens there, and you get 490,000. Just a rough idea. The DINK method stands for dual income, so both spouses are working but don't have any kids. And so all they really do, because since if one dies, you still have the income of the other, so just say, hey, what are all the funeral expenses and enough money to pay off like half the debt? So that way you're really focusing on only half. The non-working spouse, you take the number of years until the youngest child reaches 18 and multiply it by 10,000. So if you have a 13-year-old, 5 years left times 10, $50,000. The family need method is the most thorough. So I'm not going to go through it here. In your book, it's like a half a page of a whole worksheet that looks at how much debt you have, how much money you're making, how much you think you're going to need, how much assets you have, and you know, it's really a very comprehensive method. And so you can see here, there's online calculators such as Policy Genius. That's one of the more common ones. I'm going to show you one from Bankrate. So this is Bankrate, just to give you an idea. So how much we need for burial expenses? Let's say 8,000, or we can change it to 9,000 since that was like the average. If I could type it in here. How many years of income will you need to cover? Like, so this could be till your kids are going to be 21 or something. How much annual net income do you think your survivors will be? So let's say you're making 70,000 right now, and you want them to be able to receive that 70,000. And how much do you already have in your savings account? So let's say I have 20,000 already invested. So let's say we have one child who is 10 years old. Okay? And how much do you need for maybe college? You want to send them to college, and what would happen if you die? Let's just say we need $100,000 for them to go to college. And we hit calculate, and it says I'm going to need about $700,000, and there's some more information down there about that. Okay, so no, that's just so if you're doing life insurance, you're thinking about getting life insurance, and you can even see here's another place, Policy Genius. You can get quotes over here. There's a lot of these calculators where you can just kind of triangulate and see what they are all suggesting. Now this doesn't, you know, this gives you the real bare bones of kind of life insurance calculation. So different types of life insurance companies. Now, if you're buying life insurance, you're probably not going to care that much about it, but being that some of you might be selling life insurance, it's good. We have what we call stock life insurance companies that are owned by the shareholders. Most insurance companies are like this. And if you want to pay the same premium each year, choose a non-participating policy, okay, with its guaranteed premiums. So they're saying, look, we know your age right now, and we will give you life insurance. It's going to be based on this, and it's going to be the same amount as you, even as you age. Then there are mutual life insurance companies, about a third are this way, and these are owned by the policy holder. So like if you buy the insurance, you are a part owner, if you will, of this company. So when we talk about participating policies, it means that like you participate if since you're like part owner of the company. Think about like a stockholder, you receive dividends. So you pay a higher premium than non-participating, but part of the premium is refunded to the policyholder annually. And that's what they call policy dividend. So it kind of depends on, were there a lot of claims? Did the stock market do well for the money that they invested and so on? One of the most popular types of insurance is what we call temporary insurance, or more commonly referred to as term insurance. And we'll talk about that in a minute. Versus permanent insurance, typically referred to as whole life, okay? Or you can see there's a lot of different terms there, okay? So these are kind of the big terms in the insurance world when we're talking about life insurance. Do you go term or do you go whole life? Okay? So term life is a temporary life insurance policy, meaning you're not going to probably hold it until you die. You're going to buy it for a certain period of time. So imagine you have kids and then they grow up and then they leave your home. So maybe a 30-year period of time, because you have few kids and whatever, once they're 20, they will leave home. So maybe there's that 30-year period of time, or maybe between you're 30 and 60 years old, that you only really need life insurance. Before and after that, you don't need it. So you could get what we call term insurance. There's pros and cons to each type. So this is for a specific period of time. If you stop paying the premiums, the coverage stops. Okay? And it's popular because you pay the same premium for the life of the policy. The return of premium policy refunds every penny the premiums pay if one outlives the policy term. So this is just a different type of insurance. You probably you have to pay a little bit more for it, but it's just saying, hey, if you made it through the 60 and you're still alive and you paid all that money, they'll give you your money back. You got to pay more for that, but keep in mind they've had all that money that whole time. And they've been able to invest it and get all the returns on it, and so they give you your $100 back. Well, just think about time value money. It's not the greatest deal, but you were protected. So here's just a graphic I found kind of to show you a 20-year term. So I had just mentioned 30-year. Let's look at a 20-year term for $500,000. For a male who's 20 years old, look at the difference between a smoker and a non-smoker. 3 times more for the smoker. 3 times more. And when we get to 35, or look up here, this is like 5 times more. So smoking really ups your life insurance cost. So anyway, so the $32, this is like per month. I don't know why they didn't put that on there. Per month. So, a little over $300 a year for a $500,000 policy. That's very inexpensive. So most of you probably are not going to really be thinking about insurance until you're like 35. And so once again, it's not that expensive. That's term life. The other big type of insurance is what we call whole life, or permanent life. Okay? It's called a lot of different things: straight life, cash value life, ordinary life. Okay, so you kind of have like term on one side, whole life on the other. Okay, you pay a specific premium as long as you live, and the premium depends on your age when you start the policy, as almost all of them do, of course. So it provides death benefits in a savings account, accumulates a cash value. So that's a big difference from the term policy we just talked about. So this makes sense if you intend to keep the policy for the long term, or you have a bad habit in that you can't really invest for yourself. You can't do savings. So you say, okay, I'll invest in this premium and this whole life. So part of your premium goes to help pay for your insurance, and other part goes to become like a savings plan. So I remember when my dad died, my mom, because my dad had insurance for forever, and she was able to get like about 100,000, I think, in just the cash savings, because he had paid in it for so many years. and then she got some insurance on top of that. Your policy becomes paid up and you remain insured for life. Okay, so um, this means like you can pay your premium for a certain period of time until you reach like a specific age, and at that time you're paid up until you die. So that's because, you know, even though you might not have any kids at home, you want to take care of your spouse, let's say, but you don't want to pay premiums after you retire because you know it's going to be harder for you to make those payments. So the benefit is, let's make all those payments now while I'm working, and if I were to retire, then I don't have to necessarily make those premiums anymore, but I'm paid up until I die. So that's a big difference between term life and whole life. Okay? Variable life means that you get a minimum death benefit, but the value is not guaranteed, the cash value. So it depends on how well investment, the stock market is done, bond market, and whatever. Okay, so the death benefit can be greater than the minimum on the earnings invested in, separate as I just mentioned. Okay, so once again, part of your premium that you pay gets invested, and you can kind of determine where do you want that to go, more riskier or more conservative, and that will help determine how much money whoever your beneficiaries get at the end would be. So universal life, you can pay your premiums at any time in almost any amount. Amount of insurance can be changed more easily than a traditional policy. It just gives you more flexibility. It's still kind of the same thing. There's a lot of different options there, and they do change every few years in terms of all the kind of the bells and whistles. So if you're really serious about insurance, talk to an insurance person. Maybe some of you are thinking about being insurance, but they are really pretty sophisticated now in terms of what they are able to do in terms of investment products. It's not just you pay a certain amount and if you die you get an amount back. Okay? So this universal life combines term and investment elements. So that's why it's kind of under whole life, and that's what I think all of them are really kind of similar to being. So we're really kind of cutting hairs on some of these differences. Totally changing gear now is credit life, and this is used to pay debt, such as like a car loan, or more typically you see it on a house mortgage. And this means that when you go into the bank, they say, hey, do you want to get this credit life insurance? So if something happens to your spouse, doesn't have to come up with the money to pay for it. Well, typically it's considered kind of a ripoff because the banks are selling it, and that's not what they typically do. So it's better just to get your own, like a life insurance policy that would cover that amount, and that's probably going to be a lot less expensive. So just keep that in mind for credit life. Minor thing, hate to kind of be talking about all this kind of death stuff, but there are people that are like, hey, I'm going to probably kill myself, so I'm going to go out and take a big life insurance policy out, so help my family out because I feel bad for maybe whatever I did or something. Well, there's a suicide clause in most life insurance policies that says that if you commit suicide, you don't get any money at all. A rider, so important term, a rider to a policy modifies it. So just imagine you have a car and you bring on an extra rider. You're bringing on another aspect to be covered. So some examples you could have in there that, okay, if you get disabled, then it will waive your premium until you can get back to work. A lot of policies have this already written in, so just so you know, double indemnity means that if there's an accidental death, so if you're in a car accident, they pay you twice as much as opposed to just kind of dying by natural causes. Cost of living protection, which would mean that you got $1 million policy, and if inflation's 2%, it goes up 2% each year. Accelerated benefits will sometimes pay out to those who are terminally ill. So if you got a cancer diagnosis, they'll start paying out before you die because they know it's going to come pretty soon anyway. So who do you buy life insurance from? Well, of course, a life insurance company, and you can you should always check their reputations, talk to friends or colleagues or whatever, and see what kind of experience they have. But kind of the gold standard is what we call the company rating by AM Best. So you've heard of like Standard & Poor's rates company's financial situation. AM Best is the company that kind of like the Consumer Reports for insurance companies, and they rate them based on their soundness and their financial ability to pay out claims and so on. So here's just, and I know these are maybe a little bit hard to read here. I'm just going to show you that some of the largest insurance companies, you can see here, MetLife, Prudential, John Hancock, New York Life, Northwestern, Lincoln, Transamerican, MassMutual. Those are your biggest. Okay? And then you can see some of the smaller ones there. Not that it really matters. Yeah, those are by so $611 billion in terms of assets. So try to make sure your insurance agent has all the professional designations. Be careful that you're not pressured into buying something that you're just not sure about. You want to make sure that they're not pushing a certain type, because I will tell you, because at one time I did sell insurance, there are certain types of insurances, typically more the whole life, that pay much bigger commissions to the life insurance agents. So term is typically going to be your least expensive, and it's going to be the product that the life insurance agent probably doesn't want to sell you because they're not going to make as much money off of it. So just keep that in mind. And are they looking at your financial plan? So really, it should be all kind of part of a package a lot of times to say, okay, well, what's going on financially in other parts of your life to figure out, do you need insurance? Make sure you're not pressured. Okay, that's pretty straightforward. So to get life insurance policy, a lot of times you'll have to give them your medical history, so they need to know if you're smoking and whatever. If you have any pre-existing conditions, so do you have cancer right now or things like that that might impact your life. After you buy it, you have what they call a free look period, which is just kind of a 10 days window in case you were to change your mind. You always should give your beneficiaries and a lawyer a photocopy, just in case something were to happen to you and they don't know if you even have life insurance. I've had friends where spouses called me and said, hey, I think he had some more life insurance, but I don't know, and they're just kind of frantically looking around the house trying to find if there's any other policies. So if you have it, make sure you share it with somebody so they know. So evaluate the payout options for life insurance means you need to talk to your insurance agent about, okay, if I were to die, how can that money be distributed? Who's it going to go to? How is it going to be distributed? And so on. And I mean, this is pretty much what I'm saying here. We've already said. So let's move on. Last few things. One thing to keep in mind about the whole life, and we're going to revisit those here in a minute, is that you can borrow against the cash value. So remember, part of your premiums go to an investment. And so, you're 60 years old and you have this cash value build up of $100,000. You can borrow against that, use that as collateral at a pretty low interest rate if you needed money for whatever, buy a new house or whatever. And people who purchase variable life insurances may supplement their retirement income by withdrawing some of that investment proportion, like as an annuity. Annuity means it's like an amount that's going to happen every year until you die. So they have those kind of payout options. Okay, so this is kind of what we talked about, the proceeds. What could you use those for? The last thing is, in case you ever are thinking about, hey, I don't like this company anymore, or I'm moving and I don't have my old insurance guy and I want a new man or woman, um, make sure you are still insurable. Check the medical requirements in case something has happened with your health. You want to make sure you don't give up life insurance and try to get another one. I don't see that really happening. And keep in mind, the older that you are, the higher that premium is going to be. And can you keep all the provisions? Last thing, so if you go back to page 3, I know it's green here, but if you go back to page 3 and you look at that chart, this is really, and I got this out of the book, but it really does a great job of summing up the difference between the term, whole life, and universal life. So I just encourage you to kind of just read that over. I didn't really spend any time going, of course, over it earlier, but I hit on a lot of those points when I went through it, but that's a little bit more detailed and gives you a better overview of what the differences are between or amongst those 3 different types. And that's it for life insurance.